Okay, hello and welcome to day 2, setting up. In this module, we are going to prepare you with the basics, the theories, the platforms, the concepts that we're going to be using throughout the strategy. Now, the majority of this program is set up to encourage implementation and teach you, the application and implementation of a strategy. So we're not going to waste tens of hours on each individual concept. We're going to break down exactly what you need and nothing that you don't. We are going to talk through the platform, and then we're going to talk through macroeconomics and all of the different concepts we will be using. The platform that I do my analysis on and suggest you do your analysis on as well, so the charting platform we use is TradingView. If you already have it and know how to use it, fine. If you don't, there is a link and a tutorial setting up TradingView and setting up my tools, my annotations on TradingView as well. So if you want your charts to look like mine, check that out. There may be a discount code there, may not be. If there isn't, that just means I don't have one. But the link and tutorial in the TradingView subclass will show you the platform, take you to it, and teach you how to use it. Now, the actual strategy we trade, obviously, will be covered in a lot more depth in the next classes, but it's made up of an optional blend of macroeconomics or fundamental analysis and then technical analysis as well, okay? The strategy is almost 100% technical. And if you don't want to use fundamentals, you don't want to do macros, it will work fine with no macroeconomic input. But this can help to create the most high conviction biases and narratives. So if you want to trade with maximum confidence and you want to trade the system in exactly the way that I trade it, we're looking at around a 95% technical and 5% macroeconomic link, okay? Macros, crazy simple. I've simplified them. I know a lot about macroeconomic analysis, but we've chopped out a lot of the stuff there. And now we just kind of cheat our way through macros, okay? I'm going to show you how to do that in the subclass on simplified macroeconomics. It's really, really simple. We only really track interest rates, inflation, employment, and monetary policies. And we can actually just use AI to kind of cheat our way through and get our biases for the week as well. All right. So I would suggest using macros, super simple. You check that one out after you finish this core class. Aside from that, let's put macros behind us for now. We'll come back soon. We're going to talk about the charts now. So the strategy I use is pure price action, always has been. It means there's no indicators and a pure focus on only candlesticks. It's completely clean and clear, and there's no interference or distraction from any lagging inputs. So this is a trade I took recently as of the time of recording this class, and you can see how clean the chart is, right? We don't have loads of drama, no indicators, no moving averages, nothing on there really, literally just price action, but we draw really, really nice trades from it. This was about a 5.4% trade. Nice and easy. Okay, so that's what your trading is going to look like soon. So in this class, I'm going to introduce you to the different technical concepts we use inside of the strategy. This video covers the basics. This is not strategy. This is concept, okay? The strategy is made up of these different concepts, so it's good to get used to the basics of them, which is what we'll do now. The more elaborate and contextual use of the concepts will be covered throughout the creation and application of the system in lessons 3 to 8. And the subclasses beneath this core module will provide more depth on each of the concepts as well. All right, so these are the concepts. We use market structure, which is trends. We use supply and demand, which is areas of institutional buying and selling. We use market efficiency, which refers to imbalances, filled ranges, imbalance ranges, open ranges. Liquidity, referring to areas where significant money and orders are situated. Momentum, speed and size of candlesticks and what that tells us from a story perspective, and top-down analysis, simply so we can run through all of the different timeframes and gain information from each of them. Those are what we're going to be using. They're all raw price concepts and they use nothing but candles. So what we're going to do now is go over to the charts, and one by one, we'll tick these off and teach you about each of the concepts. Let's go. Okay, so what we're going to do now is go through the foundational concepts. I'm going to show you each of the concepts we're going to use inside the system, and then the masterclasses beneath this module are going to go deeper into each of these individual topics, give chart examples and all of that stuff. So I recommend you watch through this, and then if you want a deeper view, you head over to the masterclasses in the subclasses modules underneath this core video and check those out, all right? So the first one, the foundational piece of all technical analysis, is market structure. So market structure refers to the direction of the trend, and it's how we work out which way the market's going, which of course is the foundational layer to all analysis, because we need to know which way the market is going in order for us to actually trade in the right direction. So markets move in a kind of zigzag fashion. Okay, when you look at a chart, it never does this. Okay, it more so does this, and this creates high and low structure. So what you can see on the chart here is an example of what some price action may look like. And I've mapped out HH, HL, LL, and LH. This is the high-low structure of the market. So HH refers to higher high. HL refers to higher low. If the market is continually forming highs that are higher than the previous one, like this and this creates higher high structure. And if at the same time the market is creating higher lows, where every low is higher than the previous one, this creates higher low structure. And this combination of higher high and higher low structure creates an uptrend. It's a phase where the market's going up. And we can pretty much determine that the market will continue to go up so long as it keeps providing higher high and higher low structure. So that is what we call an uptrend, okay? Now, there is also downtrends, and this is made up of the opposite. When the market makes a low that is lower than a previous low, so this is the final higher low we have in this trend, okay, from this move to here, and then the market sold off like this, creating a low that was lower than the previous one. This kicks us into a downtrend, and a lower low is usually followed by a lower high, which indicates a downtrend. So this lower low and lower high structure creates a downtrending market. And while the market continues to provide lower lows and lower highs, the only direction we should be looking to go in is down. We should be looking to sell that market, okay? So that's the general high and low structure of the market. Now, sometimes we also get, well, let's just cover this first. When the market's creating higher highs and higher lows, it is in an uptrend. When the market is creating lower lows and lower highs, it's in a downtrend. In a downtrend, we only want to sell a market. So if we're seeing this price action, our goal is to sell as high as possible to profit from the fall in price. In an uptrend, we should only look to buy the market, and we want to buy as low as possible to profit from an upward move in price, okay? That's the basic format of the two trending phases. Now, there is a third phase that the market can be in, and that is a consolidation. So we'll keep those marked for now. A consolidation is basically the third situation where the market isn't going up or down clearly. Now, this phase here, basically from this high to this low, until we got this break, is a consolidation phase. So what this shows is basically a lack of direction one way or the other. You can see that we created a higher low and a higher high, but then the market came down, created this internal low, internal high, internal low, internal high, and so on and so on and so on. So basically we didn't have clear direction. Now, when we made a break here, and this BOS marking means break of structure, okay? When we made this break and formulated this higher high, that then validated this higher low as a piece of trending structure. So then we no longer have to look at this as just a consolidation. We can look at it as a basically drawn out upward move. We would average price out to look like that, okay? But in order for a higher low to be validated, so like this, we have to see the market push and create a new higher high. Until it does that, so until it was to create a break of structure over this high, anything that happens is essentially internal structure, providing it stays between the higher low and the higher high. So internal structure, to explain that concept, is basically any price movements that happen between a recently printed low and high. So the market could do absolutely anything inside of this range between the low that's been formed and between the high that's above. And nothing will actually be validated in terms of reversals until this high breaks, or in terms of continuations until this low breaks. Now, when this low got pushed through, that would validate this as a lower low, and that would validate this as a lower high, okay? But until that point, everything that takes place between these two marked red levels, therefore, is just internal structure. So if we draw that back to the point here, because we are essentially confined between this and this, all the way up until we got this breakout here, all of this is just what we would classify as internal structure, and we can't really trust any of this to trade off. Therefore, it will be a consolidation, which is essentially a sideways phase in the market that doesn't provide us really any opportunity to trade either up or down, okay? So that is the foundation of market structure. Now, inside of the structure masterclass attached to this video, we'll go deeper into impulses and corrections, substructure and swing structure, viewing structure as waves, and structure mapping on some real charts so you can see how it looks in a real market. Of course, these will be elaborated on as well as we move through the program, but this masterclass is highly recommended, okay? This day, or we could call this one week, so week 2, I would recommend just taking pretty much a day per episode to go through each of the masterclasses and practice them a little bit on the charts, all right? So check out the masterclass after you've completed this video, but this is gonna lay out kind of how the concepts work in their most basic form, and then how we kind of put them together as well. So check out the masterclass after this, but for now, let's talk about supply and demand. So supply and demand basically runs every financial market. Okay, it is a theory that is basically the driving force behind buying and selling moves. Now, when we're trading, what we're actually seeing in the candles and in the charts is buyer and seller psychology. So when we have one of those uptrends, what we're seeing in this uptrend is basically more buying or more willing buying taking place than selling. Okay, we have more demand for an asset than we have available supply. So what happens is essentially like an auction. If we're looking at, for example, because we're on Euro USD, let's say Euro USD is moving up in this fashion. Okay, what we're seeing here is a lot of buyers wanting to buy euros against the US dollars. So they say, I want to buy, I want to buy, I want to buy. If you are a seller or you are a holder of Euro USD, the asset, and you want to sell that to people, well, now you can hike up the price, okay? So imagine you have a gold coin and there are 50 people who want your gold coin. That is low supply, high demand, which means you could charge pretty much what you wanted for that gold coin and you could take the bid of the highest bidder, right? So small supply plus large demand equals increasing prices, which is what we're seeing in the market in an uptrend. We have lots of people wanting to buy the asset and the sellers can then hike the price upon them. Now let's imagine with your gold coin scenario that suddenly you're pushing up the price, you're taking high bids, someone else comes along with loads of gold coins and suddenly your gold coin is not as valuable, or someone finds out your gold coin is fake. Now they don't want it. Well, now the demand is falling off. And let's say those 50 people is now 3. There's only 3 people who want your gold coin now for whatever reason that may be. Now this is a decrease in demand, which suddenly means everyone who was happy to buy at this price for your gold coin is no longer interested in doing so. So therefore, if you want to sell it, you're going to have to basically chase the highest bidder down, and they can demand a lower price in order to buy it because they have lower demand to actually buy the asset. They're not as interested in it anymore, right? So that is how supply works, in the sense that either someone steps into the market and inflates the market with loads of gold coins, therefore there's less demand for your specific gold coin because the supply has increased, or just a general factor, something bad has happened and the demand about the gold coin has fallen because people don't want it anymore, they don't see it as valuable as they once did. Well, if you want to sell it, the price is going to have to go for less because you're now chasing down the highest bidder rather than pushing them up, okay? So that's how supply and demand works, and it's what drives every financial market. For example, gold right now is going absolutely crazy if we look at this from a big picture perspective. So looking at gold on the monthly time frame, gold is going ballistic. Why is that? Well, it's because there is a finite supply. There isn't an unlimited amount of gold. And due to macroeconomics tensions going on around the world, basically economic collapses or heavy economic uncertainty in a lot of areas, gold is seen as a safe haven. So therefore people want gold, but there's only a finite supply. So gold has pretty much doubled over the past couple of years because of the demand increase and that limited supply, all right? Now, when something happens in the market that increases demand for a different asset, well, suddenly there'll be loads more supply because people will sell this, okay? They'll sell gold to then go and buy something else. So that pushes supply into the market. That's how it works in a general trader to trader situation. So with people selling, we've seen this starting to happen actually over the past month. Gold was, let's say, at $4,400. Now, within a couple of days, it's at $4,000. It's lost $400 worth of its value. Why? Because evidently, traders are finding a different asset that they want to put money into, or they're shifting to cash, which means they are selling gold, and that finite supply is getting slightly larger in terms of what's available to the market, right? So supply increases, demand decreases, and price goes down. So basically, it's a situation where if we have high demand for an asset, markets go up. If we have low demand for an asset, markets will go down. All right, that's how it works. Now, tying that back to the theory of how it actually becomes relevant inside of the market and how we visualize supply and demand. Well, supply and demand can actually be seen on the charts as zones. So what we look for is basically after a large move to the upside or a large move to the downside, we'll talk about that one in a moment, there is usually going to be a consolidation area of some form. So I'll actually show you one on the candles right now. I'm sure we can find one pretty quickly. So here we have a sideways bit of price action, this candle at the top. We got equal wicks either side, reasonably small candle body, and then this big impulsive move down. So what this tells us is this area here is an area where significant selling has entered the market. How do we know that? Well, basically only institutional participants and only people with massive sums of money have the ability to move markets. So if we see the market top out here and then sell off dramatically as it has, well, that tells us that up here, we saw a big influx of supply and we saw a fall off in demand. So this would therefore be a supply zone, okay? Because this is the area where significant supplies entered the market. So that is how those zones work. Now this one is the opposite. This is a demand zone. So just before a big push up, we have that kind of sideways movement, that flat move. Basically the consolidation, where what we've seen there is lots of buyers stepping into the market in force, which has driven the market higher. Now, what does this tell us? Well, we think of this kind of like getting a good deal. So a demand zone, evidently, because we've seen this big buying move coming from it, is seen as a good price to buy an asset, okay? Because if we think about what a chart shows, it's showing prices. So this zone, which would be between 1.168 and 1.1684, if we look over to the right there on the price scale, basically that price range has been seen as a good price by traders to buy euros against US dollars, okay? Therefore, we could expect that if the market is able to get back to that level again, it would be seen again as a good price, a fair deal, a good level to actually purchase more of this asset. So if the market is in an uptrend, which in this instance, as you can see, indicated by a break of structure, it is, then we would be looking to buy the market in this demand zone. So this is actually what we use to get into our trades, and we focus on this over some of the weaker concepts, in my opinion, with less logic behind them, like support and resistance. What this is doing is essentially following the auction theory of the market. The market rallies, people were happy to buy at this price, the market's now pushing even higher. If the market can return to here, we think, wow, this is a good deal. It's just like if you wanted to buy a car and then the car market went crazy and the car went up by $5,000, but then it slowly trickled back down, okay? When it got back down to the level that you initially thought you wanted to buy it at, well, now you're going to see that as an even better deal because it's $5,000 cheaper than it just was. So now you're more inclined to buy it. Therefore, we often see these large price moves follow, driving us into new trending structure. Now, supply and demand zones will then usually lead into new highs and lows. So if we draw this break of structure on, this is essentially, if you tie this back to the market structure we just looked at, how we formulate up and down structure, okay? So what we actually see generally throughout uptrends, not all the time, but sometimes, most of the time, is going to be the corrective move or the pullback move we get. We talk about these more in the masterclass. Will generally be coming back to retest a demand zone, okay? So we have consolidation move, impulse, that creates a demand zone. The market pulls back to a fair price and then has another drive higher. This impulse higher can then create another demand zone. And when the market pulls back to that fair value level, we get again another drive higher, okay? So that is kind of how structure works. We pair structure with supply and demand, and it's generally how we find our tradable opportunities. You can probably see how these two ideas come together to create, number one, direction, and number two, possibility to actually get into trades. Now again, the supply and demand masterclass is going to go deeper into how to plot these zones and how to use them alongside trends. So check out that masterclass after you finish this video. But for now, let's talk about the next concept. Okay, the next concept to talk about is called market efficiency. All right, this you might know it as imbalances. If you've ever learned anything ICT concepts, you might know it as fair value gaps. I use it different to the ICT way. I've used it the kind of traditional way that it was used before ICT came up with that FVG idea. Basically, it's drawn in the same way, all right? Efficiency refers to whether a market has come back to fill open areas in price. And inefficiency is an area that hasn't been filled in price. So what I'm drawing on here is basically an inefficient area in price action. Efficiency can be determined generally by whether the markets are pushing wick to wick and whether demand zones that have been created have then been filled. So this gray box down here, this gray candle, this is a demand zone, okay? This is the consolidation move, sideways move, small move before an impulsive move away, a big drive to the upside. So we have our demand zone, impulsive move. If you consider what we just talked about, we would therefore expect the market to come back to retest the demand zone, and then a drive higher would be how we make our profits, okay? We would buy down there and take the market higher. Now, between this demand and where the market is right now, there is what we would call imbalance. Imbalance can be visualized as basically an open price area that hasn't been filled yet. And the most simplistic way to explain this is if we take a look at this bit of market here. Beneath this red line and above this red line, we have a gap in price there and we have a gap in price here. We basically have a big run up from that point to that point that hasn't been filled yet, which leaves us with an open demand. Now this area between the open demand and where price is currently trading is what we classify as an imbalance, also known as an inefficiency. So to simplify it, we would just run it from there to there. This is our imbalance. Now, what we would then want to see is for the imbalance to be filled, which number one, can provide us a trade opportunity on the way down. And number two, when it hits demand, it becomes efficient. It is no longer imbalanced, it is balanced. Therefore, we can look at then buying the market to take it higher. So what these inefficiencies act as is basically a magnet for price. We don't want to buy up here because the inefficiency is still open below. If we buy above a large inefficiency, there's reasonable odds the market is going to stop us out because markets love to fill these inefficiencies. What we're seeing when inefficiencies are filled is basically we have disparity between orders. We have a lot of orders down here on the buy side. We've had this drive higher, and now we need to see some level of, we could call it exhaustion, as markets return to fill the area where significant orders are. Now, if we think about what we said about demand zones and supply zones, they're showing areas that are seen as a discounted price or a good price to buy from. So if this is seen as a good price to buy from, buyers now will wait for the market to return to here before they start buying. They don't want to buy too high, okay? So the inefficiency is the easiest way to spot these price gaps between demand zones and where price currently is sitting. And these price gaps, these inefficiencies, these imbalances often act as a magnet for price to be drawn through quite a high probability range to see the market fill, because we know there's not going to be loads of buying taking place on the way down here. The buyers in mass are waiting at the optimal area, which is this demand zone. So that's an inefficient market, okay? And when we see an inefficiency, we want to wait for it to be filled and then we can take a trade. And if we see an inefficiency and we find an opportunity to trade through it, well, we can then trade through that into there and then trade out of it. All right. So what happens when a market is efficient? So we just talked about imbalances and inefficiencies. Well, what happens if we look at an efficient market? Now, an efficient market is formed when each demand zone or supply zone that's created is retested. So here we have a demand zone. We then saw a push away, pullback. We traded into that demand. So that's retested. We then have demand zone 2. We pushed away, we pulled back, and we've retested this demand. So this is efficient. You can see that it's efficient because when we look at where the imbalance was before, there is no longer an imbalance. There's no price gap that hasn't been filled yet, right? The area between there and there that we just looked at is filled. This area between here and here, well, this is completely filled. So there is no imbalance there either. So what this does is creates what we call an efficient range. So we can use the highlighter. Basically, all of this area here is an efficient range, okay? It's efficient. Now, there are two ways we then approach this. The first is we do not, under any circumstances, trade out of an efficient range. If this demand zone has been hit already and the market here has become efficient, well, if this market returns to this demand, we absolutely do not want to buy there again, because if the market's been able to get down into the efficient range, there is no longer anywhere significant for the market to actually create reversals from. There's no notable open orders that will drive the market higher with strength, right? So when a market is efficient, we absolutely do not want to buy from it if the market pushes into an efficient range. Now, if the market does get into the efficient range, so that would require going underneath the newly formed demand, right? This would be our new demand. If the market gets under there, so if we trade to here, this is a really interesting point, and this becomes very valuable for us, because if we push into an efficient range that has no inefficiencies, no imbalances in it, we are almost always going to trade all the way through the efficient range. So if we get under here and we get into the efficient range at all, there's a very high likelihood that what's going to happen next is going to be selling through this range all the way down to wherever the next imbalance or the next notable demand zone could be. So there are two ways then that we trade market efficiency. Number one, the primary way is when an imbalance is created. So in the existing range, that is now going to look like this. There is an imbalance between this wick and the demand zone. When one of these imbalances is created, number one, we can look to trade through it if there is opportunity to do so. That's trade number one. Number two, we can look for reversals to buy when the inefficiency has been filled. Okay, so when there is inefficiency or imbalance, it's a magnet that we can trade through and then trade against once filled. And then if the market imbalance is filled, the market becomes efficient and then pushes into an efficient range. Then we shift direction and we understand the high likelihood scenario now is going to be selling all the way through to the low of the efficient range. So that is market efficiency. Of course, again, the masterclass will go deeper into this concept, but for now, that's what you need to know. Okay, so now the next thing we're going to talk about is liquidity. Now, liquidity goes quite deep, and we're going to explain it in full depth inside of the liquidity masterclass under this core module. But for now, I'm going to show you how liquidity works alongside the concept that we've discussed, because this is the primary way that it will actually come into use. And we'll get deeper into the theory and different applications inside of the masterclass. All right. So liquidity in its simplest format refers to orders or money. Now, what we do when we're looking for liquidity is look to identify areas where there are significant amounts of orders or money, okay? And we can do this by using general trading education and just understanding where the majority of traders are placing orders, stop losses, entries, and so on. Now, the most common form of liquidity, the one we're going to talk through just here, is equal highs and equal lows. So when we see two highs at the same level like this, or we see two lows at the same level like these, or more, could be 3, could be 4, could be 5, what we are seeing there is what would be classified as a lot of traders as support or resistance. So equal lows create a level of support. General trading education suggests when the market returns to this level, you expect it to bounce again, you buy from there, and you put your stop loss under that level, okay? So we know there are going to be a lot of traders looking to trade this piece of price action in that way. They are looking for the market to return to support and then bounce off it and go higher, and they have stop losses just there. Now, these stop losses are actually sell orders, because if we think about what a stop loss actually is, if you were to buy the market from this level, okay, your stop loss is a sell order to sell the contract back for a loss if the trade doesn't go your way. So what we actually see with the stop losses down here is just a big collection of sell orders waiting to be triggered. Now, obviously, with this being one of the most common and basic formats for traders to trade, we have lots and lots and lots of retail traders trading in this same manner, which creates a big collection of orders beneath these lows and above, of course, equal highs as well, just like the example you can see here. So what we actually often get is not the reaction that traders who would trade that support and resistance method would expect. Rather than seeing the market bounce like this, we very often see the market take out these levels. So we may see this instead. Now, why would this take place? Well, this kind of ties back to what we said about supply and demand and the market being driven by buying and selling orders. When there is a lot of buying in the market taking place, markets go higher. When there's a lot of selling taking place in the market, markets go lower, okay? So generally, if we know there's a lot of sell orders in here awaiting, but these are not so generally, if we know that the area down here essentially is going to be the high interest area, then we know the range we've got open until that point, so like anywhere from where price is to down towards that support floor, is essentially going to be a low probability place for the market to reverse or continue because all the orders are down here, right? So the market is going to slowly move towards where those orders are. And when it hits a big batch of orders, then it will get its movements because there's a lot more money exchanging down here than anywhere else inside of the range. So what often happens with liquidity is we are going to, once we create equal lows or equal highs, see that as a very clear magnet point that the market is likely to be drawn towards. So there's a couple ways we could approach this market. Well, if we saw the trend was overall pointing to the upside, but then we had equal lows on the downside, we can expect that these will be pushed even if the market is going to continue trading higher. So what we can do as idea number one regarding liquidity is if this market started to shift lower on the internal structure, we could sell down into this level, pretty much because that equal low point is going to be seen as a magnet area for price. The market's going to be drawn towards there. So if we find opportunity to sell into it, then we can do just that. So first use of liquidity is if you see equal lows like a support floor or equal highs like a resistance in a market, it will act as a magnet for price and you can look to trade towards it, okay? Now, the second thing that we can do with liquidity is trade sweeps. Now, a sweep is what happens when the liquidity has been taken out. So if this market had fulfilled this move and we caught trade one from there down to here, we've now swept the liquidity. The equal lows have been pushed through and these are no longer essentially imbalanced, right? We've taken them out. Now, at this point, a lot of traders would see this as a break of structure because theoretically we've pushed through a previous structural low, right? So you would see this as a lower low, right? As we discussed before, and there you might want to sell into this market. However, something interesting happens when we sweep these points of very clear liquidity like equal lows and equal highs. And that is that because we have so many predictable sell orders in one place, we have a massive amount of sell orders being put into the market. Well, if we see that the predominant trend is up, this is a prime place for an institutional participant, so a big financial trader, to take the opposing side of the orders and drive this market back in the overall direction. So with this being a predominant uptrend, as we can see, higher high, higher high, higher high, we have higher lows, higher lows. The only higher low that's broken of significance is number one, this one, which just filled the imbalance and retested the liquidity. And number two, this one, which actually isn't a solidly viable higher low because it's equal lows, it's liquidity, okay? So we differentiate between structural highs and lows and liquidity by whether or not we have these equal lows or just one clean direct low. So once this has been swept, what can we see happening is actually a big reversal in the predominant trend direction. So it will trick some people into thinking it is a reversal, but then the market will go back the other way, again reversing in line with the bigger trend. And the reason this happens is because with all the predictable sell orders down in this region, someone needs to take the other side of those trades for them to be filled. Now, if you were an institutional participant with a massive amount of money to get into the markets, so you were a bank or a trading firm, you can't get that all in instantly, because what happens is if you try to buy the market, say here, but your order is like multi-million dollars in size, you will buy some and that will drive demand in the market up. So prices will increase. And the next part of your trade will be triggered there, the next part there, and so on and so on. So instead of being able to get a buy down here, you've now ended up with a terrible average entry because you've triggered a bit there, a bit there, a bit there, and a bit there. And now, if the market goes back down to where you initially wanted to buy, not only are you not profiting, you're actually in a rather large loss. So big traders try to avoid this from happening by finding pockets in the market where significant buying and selling is taking place, all right? Now, if we know there is a massive quantity of sell orders under this liquidity, well, then this becomes a prime point for the market to reverse when we get into there, okay? So we can see institutional participants taking the opposing side of this trade. If you've got, 10,000 people selling orders into the market, well, this one whale, so to speak, can take all 10,000 of those individual different orders and load up a gigantic buy, which therefore means the market will sharply reverse and drive completely the opposite way to the sweep. So that's the second way that we can trade it. Now, what we can do inside of our system, and you'll see this as we go, is we use liquidity sweeps to actually find trade opportunity. When a swing high or a swing low with equal highs or equal lows or notable liquidity, which you'll learn about in the masterclass, is swept, we can then identify in this area opportunity to buy against it. We can do this by just using structure and sweeps. We can do this by using demand zone reactions and sweeps. There are various different ways that we can utilize sweeps of liquidity to actually join the big participants in the market so that we can profit from the same movements they are. Instead of getting, and you might feel this if you feel like you've been manipulated by trading in the past, rather than getting stop hunted, that's what people call this, right? It's a stop loss hunt because the market comes into where you think it's going to buy, then it takes you out, and as soon as it's taking you out, it flies away. The reason it does that is because you are the liquidity in that instance. What we're doing here is setting up to join the liquidity as a profitable trade rather than being the liquidity for the profitable trades, okay? So liquidity is probably the most complex topic, okay? It's not too confusing, but it will take you some getting used to if you don't understand it already. The masterclass breaks it all down. We talk about different variations of liquidity like trend liquidity. We'll go deeper on the equal highs and equal lows, and I'll show you some actual chart examples in that masterclass as well. So if you're not already 100% brushed up with liquidity, check out the masterclass. That's going to give you a full deep breakdown as to the context and concept and exactly how you need to understand it and how we'll be using it inside of the system. And the last concept is momentum. So momentum simply refers to speed and size of candles. It's a very simple concept to understand. It's very overlooked. Now, you might have heard of all the others and you might have heard of momentum, but you probably aren't using this in your trading, even if you already are trading with concepts like liquidity and structure. The idea behind momentum is that not every move is created equally. Okay, if we take a look at these two movements here, we see the same outcome. Price got from point A to point B, right? We had a big push to the upside, but these are two completely different movements in the way that they actually formed in the market and in the story that they tell us. Now, one of the biggest things you need to understand from all of the trading we're doing is we're reading a story, okay? Candlesticks like this tell us a story in the most simplistic way. Now, if we take a look at the first move, this is a very strong bullish move, a push from there up to there in one single strong candle, all right? So that is move number 1. That tells us buying is incredibly strong. Now we can take from this 2 things. Number 1, the speed. We can see that within one single individual candle, we completed this full move from down here to up there. So that alone is obviously one important factor. If a market is moving up very, very quickly, it shows clear control from buying or the buy side. If it's moving up very, very slowly, it shows less control. Okay, so speed-wise, this one is of course a lot slower. It's taken, 1, 2, 3, 4, 5, 6, 7, 8, 9 candles to achieve what one candle has achieved in this other scenario. So speed of move is one important thing to consider. What can that tell us? Well, we know that a fast move, like this one, shows uninterrupted buying taking place. We've seen buyers fly this market up with pretty much no resistance from selling. This one, however, we are seeing resistance from the sellers in the form of, well, we can see some great candles, we have lots of wicks, and it's taken 9 times the amount of time to get to the same point, okay? So we can see clearly from that this is a slower or weaker move. Now, the other thing is the size of candles and different candle elements. Candles are made up of 2 parts. We have the body, this blue bit, and we have wicks, this bit here. Small wicks, like the ones we see here, are indicative of strength if paired with a large candle body. We have only small wicks showing only small amounts of rejected price action. Then we have a very large candle body, the blue bit, which shows us that the buying pressure and the strength in this market is very much in motion, right? So this means there was very little in the way of up and downside rejected prices and very much in the way of confirmed price move. If we take a look at this one then, the candle bodies are small. They're like little squares as opposed to a gigantic rectangle. There are wicks, sometimes coming down quite strong on the top. These show rejected attempts to go higher. What this shows is the market went up there, but got pushed all the way back down here. So in reference to the size of the candles and candle elements, large candle bodies and little to no wicks is much stronger than smaller candle bodies and larger wicks, because this shows uncertainty. It's showing rejection one way or the other. And basically, this move, based on the speed and the size of different candle elements, is a lot weaker than the move to the left. All right. So how does this actually become valuable in our trading? Well, there are a few ways, and the Momentum Masterclass shows you all of those. But to break it simply down, generally, we always want to be trading on the right side of the market, right? Which means we want to be moving with sellers when demand is low and supply is high. And we want to be moving with buyers when demand is high and supply is low. So if we want to always be on the side of the strongest team, essentially, we can use this momentum to gauge who the strongest team is. So I've set up this scenario. Let's say we have a structural high just here. We've got our structural low just here. And now we're trying to decipher which way should we take this market. Well, if we take a look at the speed and the size of the candles and consider the overall momentum, we see that we saw a giant selling move happening very quickly. The buying move, however, took ages to get back up. This immediately tells us that at this point in time, it seems that sellers are stronger than buyers, because buyers are seeing resistance from sellers, these gray candles, and they're also only managing to move the market up very slowly. They have to put up a fight essentially to make this happen. However, the sellers, when they drove the market, they totally dominated. So this tells us that selling is the most likely outcome next. Now, if the market was then to trade into an area of supply, like this, for example, as it now is, we could see this as a pretty strong sign that we probably want to be selling this. We would anticipate the next movement for this market to make would be something like this. So if we were to sell from here, we'd be in for a good position, basically executing at the top of this weak move in what we could classify as a strong point of interest to then sell into. All right, so that's one way we could use it. Now, the other way we can use it, and this one less people talk or know about, is we can use it to determine when a break is actually a valid and strong break. Now, let's say this market pushed over the structural high. Okay, we had some wicks first of all, like this, but then eventually we did manage to make a closure over that high, right? What would this tell us about this market? Well, you might on the surface think this tells us the structure is breaking to the upside because we have indeed pushed over, as discussed, a structural high. So we could say, well, now that we've broken structure, we could actually look at buying pullbacks, okay? And lots of traders do this, and this is where they go wrong. If we consider the strength of the participants in this market, we can clearly see, considering what we've just discussed, sellers are most certainly stronger. And even if buyers have managed to break structure here, they have done it with so little force and so little conviction that we can very quickly see this entire movement reversed. So there runs a risk of this turning into a sweep like what we just discussed. And we can get a big selling move following, even though on the surface it looked like structure broke. So momentum is used, first of all, for identifying which way you should be going with the market. In a case like this with strong selling moves and weak buying moves, we would certainly be looking at selling. And it can also be used for filtering positions, all right? If you're looking at a trade and you see the market break structure to the upside, but it's in a movement that's this weak and this slow, well, now you can say, I'm not going to get in here. I'm actually going to wait and see if this starts to break down, because if it does, could be a good trade worth taking the other way. So that is how we use it. Directional filtering, essentially, to catch good trades where we're on the right side and avoid bad trades where we may be on the wrong side. Now, the Momentum Masterclass breaks down some depth regarding multi-candle momentum and a bunch of other stuff, so check that out for sure. But that is the last concept we use. Now you understand each of the foundational concepts we'll use inside of the narrative-based strategy. The subclasses beneath this core module include further education on each topic. I want to make sure you're really dialed in, so this is kind of the long bit of the course. If you feel like you already know the concepts, if you followed me for a while and you're here for implementation and systemization, then you don't really have to watch those. But if you want to see more examples of each of the concepts in action, so you understand exactly how they work and you feel like you need an extra little push, go ahead and do that. Check out those additional classes. They're going to give you deep insight into each of the concepts before we move on, okay? Now, there's also education on the simplified macroeconomics and how we can cheat our way through macro analysis in a really simple and fast way. Explore these and make sure you're confident with the basics of each concept before moving on to module 3. And when that is done, meet me for day 3. I'll see you there.